Welcome to today's episode, where we're looking at one of the more complex and often misunderstood ways to blend property and retirement by investing through a self-managed super fund. For some investors, it's a powerful structure that can offer control over your investment decisions, tax efficiency, and a clear pathway to use property as part of your retirement strategy. For others, it's a minefield of rules, fees, and traps that can undo even the best investment plans. As with all our Season 3 episodes, today's topic was inspired by a listener question. And the question is, my financial advisor suggested I might buy my next investment property inside my self-managed super fund. How do I know if it's right for me? To help me unpack this one, we have one of Australia's leading experts in self-managed super funds, Katie Timms. Katie is the National Director of Superannuation and Self-Managed Super Fund Services at RSM Australia. So if it involves property and super, Katie's seen it all. Katie, welcome to the podcast.
Thank you for having me.
Now, lots of people have heard about self-managed super funds, obviously, but what are some of the pros and cons of setting up a self-managed super fund?
Well, you mentioned one of the main ones, which is control. A lot of people really like the idea of self-managed super because it means they're the ones making the decisions. They're not sort of putting their money away with some investment manager who's putting their money into managed funds that they don't understand. People like to know where their money is going, and self-managed super lets you take charge of that. That's the really big advantage that a lot of people see.
Yeah. Do you find that even some people who use self-managed super funds still use a financial advisor to help them allocate their assets?
Absolutely they do, and it's always recommended. There's a lot of people that think, I know better, and sometimes you do, but a lot of times financial advisors bring you experiences and a depth of knowledge that you're just not going to get, using ChatGPT or something else to try and find it out for yourself.
Yeah. Now, I've got a self-managed super fund. One of the things I like about it is I can pretty much invest in anything. I won't say entirely anything, but you have a broad variety of products. If you go to obviously the retail funds, you're quite limited into what you can invest in. So I think that's one of the reasons I like it. I can choose to invest in things that otherwise I couldn't get access to. Do you find a lot of clients feel that way?
Absolutely. I mean, the great Australian dream is property, right? So I love to use my parents as an example. They love property. They have always bought property. That's always been their investment. And they never trusted shares. For them, they liked to be able to say, that's my retirement right there, that property. And it made it real and tangible for them. So for a lot of people, whether it's property, gold is a really big booming one at the moment. People are a little bit uncertain, but knowing that that's my investment, I tangibly know what it is, it just seems to bring comfort to people.
Now, it all sounds great, but there's a lot of rules and regulations with self-managed super funds. So can you tell me some of the obligations on a self-managed super fund every year that they have to go through?
Yeah, look, self-managed super, a lot of pros. The big con is the most heavily regulated investment vehicle in Australia. We always say people that work in this are experts in trust law, corporate law, tax law. You have to be across everything because they are so heavily regulated. So every year your super fund has to do a tax return, the financial statements. That's the easy bit. It then also has to be audited every year. So an auditor is looking through everything your fund has done. They are assessing, have you complied with the rules? Is your tax reported correctly? And a lot of that comes with work, with paperwork, and really needing to have the right people around you so that you can understand exactly what the rules are.
And particularly if you've got unlisted products, that's hard sometimes to value, but the auditors have to do a valuation each year, don't they?
Yeah, they do. So everything needs to be reported to market value every 30 June. There used to be this kind of belief that property values didn't change that much, and so we'd only really do it every 3 years. I think we're seeing that's not so much the case these days. So, whether it's property, commercial property, managed funds, unlisted companies, those sort of things, all need to have a value every year, and that's one of the headaches that does come with these sort of vehicles.
And a lot of people think, well, I'll get a holiday house in my self-managed super fund. And can you just explain the sole purpose test and how important that is to comply with that as a self-managed super fund?
Yeah, it is the underlying principle for superannuation. Your investments have to be held for the sole purpose of providing a retirement benefit for you. Now, everyone always says to me, of course it is, I'm planning to make money, and that's what it will be at the end. But it does exclude the ability to get any kind of benefit from it now. So you can't buy a holiday house and go and use it yourself, because that's actually not providing for your retirement in the future. That's giving you a benefit right now. And that is the biggest no-no in superannuation world.
And sadly, unfortunately, a lot of people, I'm not going to say a lot, people do that. And if you get caught, what's the penalty? Pretty significant.
Very significant. I do get a lot of people when they first start this conversation say, oh, but how will they know? You know, I've got a friend that will sign the lease agreement that says they're not, you know, or it's just vacant.
Yeah.
I've seen auditors use Google Map searches and say, you know, point it and say, there's laundry on the washing line.
Right.
Someone is in that property, you know, and I've done it myself. Someone said, I've got a fruit orchard on there, and you do the little map search and you're looking and you say, great, you've got like 5 trees in the corner. You know, that's not a, you know, commercial fruit orchard. So you always get caught. And when you do get caught, it can be really significant. It's from as simple as, you know, the ATO might send you off to get some education if they think it's not too bad. They might give you trustee penalties, which are payable personally, and they can be upwards of $20,000. The very worst case thing they can do is they can say you are a non-complying fund. So you have broken the rules to the extent that we do not trust you to have one of these again. We're going to tax half of your assets. We're going to tax all of your income at the highest marginal rate and disqualify you from ever doing this ever again.
Yeah, and that's obviously not worth it. So the message is, if it's setting up a self-managed super fund, it is for your retirement. You're not going to get any personal benefits out of it. However, there is one, if you own a commercial property and have a business. Do you want to just tell us about that and how that works?
Yeah, that's my favourite strategy to use in a self-managed super fund. It basically means that you can buy, or your super fund can buy a commercial property, but you can then lease it to your business. So different to a holiday house where you are not allowed to use it personally, for a commercial purpose, you absolutely can. As long as everything's done like on arm's length terms at market rates, you know, you're not getting any little sneaky advantages along the way, you can absolutely do that. So your business can be leasing a property off yourself. So you're, you know, getting the ability to put more money into super while you're getting a tax deduction for it outside. I mean, that is the real benefit to having one of these vehicles.
And that's, I think, for a lot of business owners, it's a common use of it, isn't it? But do they need to get valuations? Again, how do you know market value on rents? I mean, it probably makes sense to get a real estate agent to say this is what market rent is.
Yes, correct. So you need to value the property every year. You also then need to make sure that along the way your lease arrangement is market. So you need to have a lease agreement. You know, is it a standard lease agreement? Like, is it what you would do with anyone else? You know, do you have evidence that the rent that you're charging is at market rates? Are you actually paying the rent? You know, that's one of the risks that always comes, is that people think, oh, business is going tough, I just won't pay that because it's to myself. That's the worst thing you can do. You have to make sure that everything is exactly as it would be with an unrelated person.
Katie, since 2007, investors have been able to use the self-managed super fund to buy residential property, and, well, they always, I guess, could, but importantly, they could gear it. Do you want to explain how that works and the bare trust and all the other complexities that do go with that?
Yeah, look, this is a really unique part of self-managed super fund because it came about by accident. And I always love to explain to people this story because it explains why it's kind of changed so much over the years, because government never wanted super funds to borrow. It was never part of their plan. And then they issued Telstra 2. Now, if you're old enough, well, you are. So, you know, you and I both remember, right, when they issued that, they did it on instalment, which actually meant that the people that bought it were technically borrowing, and most of the people that bought that were self-managed super funds. So the government, instead of saying, whoops, made a mistake, we need to change it, they said, we'll just change the law. And so along the journey, it's kind of evolved into this way of super funds being able to borrow, but they've tightened it up so that it's under very specific rules. So it's under what's called a limited recourse borrowing arrangement. It involves a bare trust structure that holds the property on behalf of the super fund, and the only recourse the lender has is against the asset in that bare trust. So it's reasonably complicated, it can be expensive, but it does let people get into properties maybe a little bit earlier than they would normally be able to in super.
And importantly, from a property perspective, as a buyer's agent, we always work with the advisors to get the right naming convention, because it's obviously, you've got often a corporate trustee for a super fund as trustee, and then you've got a bare trustee. It's all very complex. But we listen to the advisors, and that's important. You've got to have that set up before you actually buy the property, don't you?
You do. I can't tell you how many times people ring me and say, hey, we want to do one of these. I've found the property, I'm putting in the offer now. And we have to say, stop, stop, stop. You have to make sure all of your entities are, you know, set up before you put in the offer. Because if they're not, the Office of State Revenue can look at the offer and say, well, this company that's on the offer didn't exist. And they can see that, ASIC tells you. So they can say, well, you must have bought it in your own name, then put it in the super fund. We would like another clip of stamp duty, please. So it can be really expensive to get it wrong when you just need to wait maybe a couple more days or get the right advice in advance. Yeah,
absolutely. And that's a critical thing, getting it in the right structure, obviously, but getting it all set up. But as we know, most people think about all those things afterwards. They're not accountants. So the advice is, before you're going to do this, go and get it all set up and then you're ready to go. But importantly also borrowing. It's the other thing I'd say to people, make sure you actually borrow in your super fund, because it's not always that easy. Have you seen clients come unstuck where they wanted to use a bare trust and buy a property and not be able to get the finance?
Yeah, usually they're the ones that we pick up when they say, hey, I've tried to do this thing and it became a mess. I always say to people before they start these, go and talk to your broker, go and talk to your buyer's agent, do all of that before you even set up any of the structures, because there's no point starting down the path to then get a no, and you've had all of this outlay, you've possibly fallen in love with this property that you thought was going to be your great, investment vehicle, and it just hasn't come off because you haven't had all the conversations. So it should be a 3 to 6 month lead time. Talk to all of the right people, get all your ducks in a row, and then go ahead. Because otherwise it can be expensive and it's just dead money.
And it's been interesting, it's nearly 20 years since we've been able to borrow to buy property in a super fund. And over the journey, the lenders have gone in hard, they've loved it, then they hate it, and then some of them like it, some of them don't. And sometimes the rate's been a bit high, and sometimes it's comparable to a normal investment loan. So I think that's the critical thing. Where you are in the cycle and where you are, go make sure you can actually borrow to buy that investment property. And because it's non-recourse, of course, their lenders are a little bit more hesitant, a bit more cautious about it, because if the values drop, they can't get any recourse against you personally, and also the super fund itself. So yes, definitely get it checked out with your lender. That's really important. Outside of super, we often talk to people about buying an investment property, and most people don't save for a deposit after that. They're using equity in that property that they bought to buy the next one. Now, tell us what you can and can't do in a super fund with that equity as it grows.
Yes, you cannot do anything with it. That property must be fully self-contained. That loan can only apply to that particular property. You can't, sort of use that equity that you've built up to borrow another one. No, you have to have the existing cash for any future deposits. You also need to be really careful about what you do to the property while it's got the borrowing on it. So one of the things that the government tends to worry about with these is that obviously having borrowing exposes more risk, particularly around the property. And what they don't want is you putting more money into that property while there's a borrowing on it. Because if the asset that the bank has recourse against is the property, and you've spent, a heap of money redeveloping it and doing all of that, you've put more assets at risk, and that's the opposite of what they want. So you can't borrow to improve the property. You can't borrow, you can't change the nature of what it is. So you are basically buying a property. You can do some renos on it, but if it was a 4-bedroom house, it needs to stay a 4-bedroom house. You can't have a house, do a knockdown, build, some townhouses. You cannot do that with one of these kind of things. This is a buy, hold, rent, sell in future to do another one, but we're not investing extra money.
And we've definitely seen that. People get excited. They go, I'm going to buy an old rundown house. I'm going to build some townhouses. We go, you need to go back and talk to your advisor, because what we know, we're not your advisors in this space, that you can't do that. So again, seeking that advice up front. So people can borrow also for commercial property, can't they? There's no difference to residential.
No, absolutely they can. You tend to find the loan to valuation ratios are a little bit lower. Commercial properties, don't have quite the same sort of income yields, but absolutely you can. And again, we see a lot of business owners do that as well.
Yeah. And of course, there's been a lot of talk about Division 296, which is when you've got more than $3 million in a super fund, you're going to get taxed a bit more. And we had some clients worried about liquidity, and particularly when it's going to be unrealised gains. That's now gone. Do you want to explain, if you have fortunate enough to have $3 million or more in super, how this now affects you, these new laws, and then I guess importantly, how important is liquidity, or is it less important now that it's only on realised gains and not unrealised?
Yeah, so this new tax that's coming in, essentially what it does is they're trying to take away the tax benefit that exists inside of super. So self-managed super funds, up until, this new tax coming in, you only ever paid maximum of 15% tax, which is why I love working in super, because I'm never talking about, highest marginal tax rates, it's 15%. What they wanted to do is say, well, there should be a limit to that. You shouldn't be able to have this amazing tax rate regime if you've got 10, 15, 20, million dollars in super. So what they said is that, look, up until $3 million, you only pay the 15% tax. Over $3 million, they then say the proportion that you're over, you pay an extra bit of tax on the earnings. And that proportion part is really important. If you're only just over 3 million, if you're at 3.1 million, say, that $100,000 you're over, on the earnings that amount generates, you'll pay an extra 15% tax. And over $10 million, they say, that's really extreme. You'll pay an extra 10% tax on top of the extra 15% tax. So, it's really just limiting the tax benefit that exists on superannuation, but it is only on actual income. So previously, you're right, we were talking about unrealised gains, which meant you were going to be taxed on asset value movements. Now, we had property owners, we had farmers, we had everyone in absolute panic saying, I haven't even made the money. How am I going to be paying this tax? They've changed it, thank God. They've come back and said it's only on actual income, it's only on actual capital gains you make. So liquidity is a bit less of a concern. And we do have some capital gains tax relief that exists as well. Now, that's a whole other topic. I don't want to bore you on that. But if you are someone that does have a super fund, there is the ability to get some capital gains tax relief for this tax.
So just so let's say you had 3.3 million and let's say your super fund made 150,000. The top-up tax of 15% would only go effectively on that 10%. Is that right? So you'd only pay an extra 15% on 15,000.
Correct. So the numbers aren't as big as what we thought they were going to be in the first instance. So that proportion becomes really important. It's still a better tax rate than you're going to have, particularly up to $10 million, than you have outside of super. So it certainly doesn't make them any less attractive. It just takes away a little bit of cream off the top.
Yeah, and if you're in pension phase paying zero, so you're still only paying 15.
Absolutely,
so,
magic.
Yeah, baby boomers have had a good run in this. Gen X like me, you're a bit younger than me, Katie, but we're still trying to get our money in super.
A millennial, thank you very much.
I'm sure you are. I would have thought it's even younger than that, but anyway.
Bless you.
Yeah, so, but it is not as easy now to get money in super, is it, for younger people? That's why do you think we're going to see many more $10 million balances coming up?
No, we're not. The changes that came in, almost 10 years ago now. So again, I'm showing my age a little bit, Damian, but in 2017, there were the big raft of changes that forced a lot of money to come out of super on death. They, brought in limits on how much you could have in pension. We're never going to see $20 million funds again, or more because of those rules. It's just was probably going to take a little bit longer to try and flush all of that money out of the superannuation system. And so the government wanted to bring these sort of taxes in to really take their clip along the way. And
what happens if if a spouse, partners, one of them dies, it generally goes to, depending on the binding death nomination, goes to the other partner. But when both, let's say it's a traditional family, two mum and dad and a couple of kids, when the second one of them passes away, the money has to come out of super, doesn't it? You can't just keep that for generations.
No, super funds, prior to these rules, there was the ability to keep a little bit more money in super when people passed away. That's all gone. You can pass a certain amount across to a spouse and keep it in the super environment. Once both are gone, that's it. It does have to leave, the superannuation fund, and there could be a tax along the way as well. So we want to make sure we don't have these huge amounts of money in super when we die.
So people worry about liquidity and all these things. I'm assuming they have a certain amount of time to sort that out. You don't have to take it out the day after the death, right? How long do you have to sort that out and pass the assets out?
The technical answer is as soon as is practicable, which is how long is a piece of string. The ATO kind of thinks it should be 6 months. They say, why would it take you longer than 6 months? The reality is, sometimes it can take you 6 months to get probate. Sometimes it can take a long time, particularly if you've got property or, complex asset structures that are actually just hard to get out of super. So it can take a little bit longer. As long as you're kind of taking the right steps, you're not hoarding it in there to try and take advantage of these great low tax rates. The ATO is pretty, flexible on these sort of things.
And one of the questions we get asked on our Westbridge side of the business is when they've got unlisted property funds, what happens when they die? But let's say again you have two children, you can pass those units out directly to either one of those you choose, I gather, or either 50-50. So you don't actually necessarily have to sell assets, you can pass them out, can't you?
Correct. You just transfer them in specie. So there's a lot of benefit to that as well. Some people get quite attached to their, their investments and their property, or their Westbridge funds, and they want to see that pass to the next generation. They've been a great investment for them. You can absolutely do that.
Yeah. So, Katie, you've seen over the journey, I'm sure you've seen people make mistakes with this, and that's why you need to seek advice from someone like yourself. What's the worst you've seen in the self-managed super fund?
Oh, that's a really big one. We tend to see, I have actually seen I'm not using it personally, and we've seen that. I've seen a lot of people really dip into their super. So, when the business is not going well or things aren't going well, it's really tempting for people to just be like, but I can see that money. It's just there. No one, I'll just take it and I'll put it back. And often they don't. So we tend to see those sort of things. I tend to actually see a lot of people that have just gotten really bad advice. So people that have tried to do the right thing and they come in and we just say, this is all wrong. What you're advised to do has not been the right thing. And a lot of times that can be really expensive to unwind. So, I had someone, would you believe, come in and say, I think I've got a super fund. And I said, well, what do you mean? And they say, well, I've kind of got these documents and they've got trust deeds and things. And they say, well, where did you get that? And they say, I was walking through a shopping centre.
Right.
And it was a property spruiker in a shopping centre. And they've ended up with, they think, an apartment in Queensland somewhere. But that's, people get caught up in the excitement of all of this sort of thing. So I do like to help people out of those situations, but that was a really expensive problem because they just didn't actually even understand what they had.
Yeah, I think that's a good point. If someone is a property spruiker, we love property obviously in our business, but we don't give advice on self-managed super funds because you need a financial services license to do that. Those property spruikers shouldn't obviously be doing that. So what would you say to someone if they're getting pressured or suggested that they set up a self-managed super fund? Who do they need to talk to rather than just someone with self-interest? Who should they be talking to before going ahead?
They absolutely should be talking to either someone like myself as an accountant who specialises in SMSF or a financial advisor who also specialises in SMSF, because not all of them do. I think it's really important that people are getting independent advice. And if at any point they are saying things like, I'm feeling pressured, or they're telling me to do this, I say that may not be the right thing for you, because if someone else is telling you that it's right, there's probably a self-interest piece in there.
Yeah.
And there needs to be someone independent saying, hang on a minute, is this actually what's right for you in your circumstances? I always say, I spend the first hour of talking to anyone trying to talk them out of it. I will tell them every single horror story, every single pain that's going to come through with, having to keep records and having to pay bills and having to do all of that. And then at the end of that, if they still think, okay, I understand it, I have a really clear idea of what I'm going into, then I say, then we can take next steps. But warts and all.
And that's, again, where you need the advice. I've got one myself, and I've lost track of the amount of trust deed changes I've had to do over the years. It seems like I'm tossing one out, and again, I'm relying on the advisors to do that. And that's critical, isn't it? You've got to have that advice, someone who knows what they're doing, and not all accountants know exactly what they're doing, because these trust deed amendments have to go through to be complying funds, don't they?
Yeah, absolutely. I've been doing this for more than 20 years, and that's all I say now is just more than 20. But this is all I do because it's so complicated. I can't keep up with anything else in the tax space. This is it. This is a full-time, just to be able to keep up with things that are constantly changing, making sure clients are looked after, making sure they understand what's going on. I don't think super is the way it was 20 years ago, when you could kind of be a bit of a GP and you could do a bit of everything. It's just not that anymore.
No, it's a very complex area. Now, what do you see generally clients have in their super before they think about setting up a self-managed fund?
Look, we always say to people, and look, ASIC has numbers out around this, so they say it shouldn't be less than $250,000. I think that's a minimum. You'd want almost more than that, unless there's a really specific reason for going into the superannuation fund. So what's the purpose? And that's kind of where I get to with people is, well, what's the point? What are you trying to achieve in this? And if it's something like, oh, well, my mates have got one, that's immediately, well, no, that's not the right reason to have one, just because the guy that I sat next to on the plane on the, up to the mines, that's not the right reason to have one. What are you trying to achieve with it? Because it's going to be a headache for you. And I don't want you coming back to me in 5 years to say, oh, this was a terrible idea. Why did you make me do it?
I think you've got to have some level of financial discipline. And even you were talking about the sole purpose test. As much as, again, we love property, if that's your only asset, you've got $250,000, using that all as a deposit on a property, it probably doesn't make sense. We're not here to give advice, but that is very concentrated, isn't it?
Absolutely it is. You want to make sure that, if you're younger, maybe, yes, you're willing to take a little bit more risk with, your investments. You're happier to gear a little bit heavier. But do you understand what you're going into? Have you thought about, you might say, oh, but I could do better. Well, maybe you should leave some behind in your other fund to kind of give yourself diversification, to cover yourself on what the markets do. So it's not a simple thing to go into, but a lot of people think it is.
Yeah. So if you're going to put all your money in Bitcoin, it probably self-managed super funds not the way to go.
I have some of those, not ones that we've set up or done, but they've come to us and say, here it is. Yeah. I have had one where they've lost the very important little part. I'm too old to understand it properly. But, again, if you're young and you want to take that risk, but just be aware that that money at some point is supposed to be there for you to be able to retire. And if you've taken too many risks along the way, your retirement's not going to look anywhere as nice as what you'd want it to be.
Wise words, Katie. Thanks very much for joining us today on the podcast. And certainly for people out there thinking about a self-managed super fund, you need to surround yourself with great advisors like you, and if you're going to go down this path. So thanks again for joining us.
Thank you very much for having me.
For the right investor, a self-managed super fund with property can deliver growth, income, and great tax advantages. But there's no one-size-fits-all approach. Self-managed super funds are not automatically the next step. They're a specialist tool. Expert guidance for compliance is a must.